China just gave a silent order to its largest banks: reduce your exposure to U.S. Treasury bonds. It wasn't an official announcement. There was no press conference. It was a verbal instruction, discreet, almost invisible. But the implications? They could change the global financial system as we know it. Hello, welcome. Before we begin, I want to clarify that this content is for educational and informational purposes only. It does not constitute financial advice. Always consult with professionals before making investment decisions. Now, let's talk about what's really happening. China, the world's second largest economy, has been quietly, gradually, but steadily reducing its holdings of U.S. Treasury bonds for over a decade. And those banks, according to data from September of last year, held approximately $298 billion in dollar-denominated bonds. That's not a small amount. But here's the interesting part. This isn't a fire sale. This isn't panic. This is strategy. It's diversification. It's risk reduction. And it's a signal that confidence in the U.S. financial system, while still strong, is no longer unquestionable. So what exactly happened? According to reports from Bloomberg and other financial media, the Chinese government gave verbal guidance, not a formal written order, to some of its largest state-owned banks to limit their exposure to U.S. assets, particularly Treasury bonds. Why verbal and not written? Because a formal order would be a public declaration, a direct geopolitical statement. A verbal instruction is more discreet, more flexible, and allows for plausible deniability if necessary. But make no mistake, when the Chinese government suggests something to its state-owned banks, it's not really a suggestion. It's an order with good manners, and those banks are listening. According to official data from the U.S. Department of the Treasury, Chinese banks' holdings of dollar-denominated bonds stood at approximately $298 billion as of September last year. But that figure is just part of a much larger picture. If we look at China's total holdings, not just banks, but also the central government, sovereign wealth funds, and other state entities, the number rises to approximately $683 billion as of November 2023. That's a lot of money. But here's the key. It's much less than it used to be. In fact, it's the lowest level since 2008, and it's part of a trend that's been going on for more than a decade. To understand the magnitude of this shift, we need to go back in time. In 2013, China held approximately $1.3 trillion in U.S. Treasury bonds. Today, that figure has been cut by more than half. We're talking about a reduction of over $600 billion in just over a decade. That's not a minor adjustment, that's a fundamental strategic reorientation. And this didn't happen overnight. It's been a gradual, deliberate, calculated process. Year after year, quarter after quarter, China has been reducing its exposure to U.S. debt. Sometimes the reductions are small, almost imperceptible. Other times, they're more significant. But the trend is clear and consistent. China is diversifying away from the dollar in U.S. assets. When news of this verbal instruction began circulating in financial markets, the reaction was mixed. Some analysts said it was nothing new, that China had been reducing its treasury holdings for years. Others saw it as a warning sign, a symptom of something bigger, the gradual erosion of the dollar's unquestioned status as the world's reserve currency. And the markets? Well, the markets don't like uncertainty. U.S. Treasury bond yields, which move inversely to prices, experienced volatility. Not a collapse, but enough movement to make investors nervous. Because if China, one of the largest foreign holders of U.S. debt, is reducing its exposure, who's going to buy those bonds? And at what price? The answer, for now, is other investors, other countries, and the Federal Reserve itself through its monetary policy operations. But the question remains, for how long? And at what cost? Because every time the U.S. government needs to offer higher interest rates to attract buyers, the cost of servicing the national debt increases. And with a debt of over $35 trillion, even small increases in interest rates can translate into hundreds of billions of dollars in additional annual costs. This creates what economists call a debt spiral. Higher interest rates mean higher debt service costs. Higher debt service costs mean larger deficits. Larger deficits mean more borrowing. More borrowing means more bonds to sell. More bonds to sell means potentially higher interest rates to attract buyers. And the cycle continues. This isn't something that happened overnight. China has been reducing its U.S. Treasury holdings since 2013. Back then, China held approximately $1.3 trillion in U.S. Treasury bonds. Today, as I mentioned, that figure is around $683 billion. That's a reduction of more than 50% in just over a decade. Why? There are several reasons, and they're all interconnected. First, diversification. China doesn't want all its eggs in one basket. It's been buying gold, lots of gold. In fact, China has been one of the largest buyers of gold in recent years, adding hundreds of tons to its reserves. It's also been investing in infrastructure in other countries through the Belt and Road Initiative and diversifying its foreign exchange reserves into other currencies like the euro, the yen, and even the British pound. Second, geopolitics. The relationship between China and the United States has become increasingly tense in recent years. Trade wars under the Trump administration continued under Biden. Technology sanctions, particularly in semiconductors and advanced computing. Disputes over Taiwan, which China considers a renegade province and the US supports with arms sales and diplomatic backing. Human rights issues in Xinjiang and Hong Kong. The list goes on and on. And China has learned a very important lesson from what happened to Russia after the invasion of Ukraine. When you have geopolitical conflicts with the United States and its allies, your dollar-denominated assets can be frozen, sanctioned, or even confiscated. Russia had approximately $300 billion in foreign reserves frozen by Western sanctions. That's a lesson China won't forget. So reducing exposure to US assets is also a form of financial insurance, a way to protect against potential future sanctions. Third, economics. China's economy is changing fundamentally. It's no longer as dependent on exports as it used to be. For decades, China was the world's factory, producing cheap goods for Western consumers and accumulating massive trade surpluses in the process. Those surpluses were recycled into US Treasury bonds. But now, China is focusing more on domestic consumption, technological innovation, and moving up the value chain. It wants to produce high-value products, not just cheap toys and textiles. That means it doesn't need to accumulate as many dollars from trade surpluses as it did before. But there's another side to this story, and it's not pretty for the United States. The US has a massive, unsustainable fiscal deficit. We're talking about a national debt of over $35 trillion and growing every single day. The annual deficit, the difference between what the government spends and what it collects in taxes, is approximately $1.6 trillion. That's trillion with a T. To put that in perspective, the US government is spending about $1.6 trillion more than it takes in every single year. That's like a household earning $50,000 a year, but spending $73,000. It's unsustainable. And the only way the government can finance that deficit is by borrowing, by issuing Treasury bonds. And for decades, there's been no problem finding buyers. Why? Because US Treasury bonds have been considered the safest asset in the world, the risk-free asset, the ultimate safe haven. If you wanted to park your money somewhere safe, you bought US Treasuries. It was that simple. But what happens when the largest foreign buyers start reducing their purchases? What happens when confidence in the US government's ability to manage its finances begins to erode? What happens when investors start questioning whether the US can actually pay back all that debt? Well, the government has to offer higher interest rates to attract buyers. It's basic supply and demand. If there are fewer buyers for your bonds, you have to make them more attractive by offering higher yields. And higher interest rates mean higher debt service costs. It's a vicious cycle. It's like paying off one credit card with another credit card. It works for a while, but eventually something has to give. And here's the scary part. The US is already spending over $1 trillion per year just on interest payments on the national debt. That's more than the entire defense budget, more than Medicare. It's one of the largest line items in the federal budget. And as interest rates rise, that number will only get bigger. And the markets are reflecting that uncertainty in multiple ways. We've seen extreme volatility in gold prices, which have hit record highs above $2,000 per ounce, then pulled back, then surged again. Gold is traditionally seen as a safe haven when confidence in fiat currencies declines. The fact that gold is at or near record highs is telling us something about investor confidence in the current monetary system. We've seen volatility in currency markets, with the dollar strengthening and weakening against other major currencies in wild swings. Sometimes the dollar rallies because it's still seen as the safest currency in times of crisis. Other times it weakens because investors are concerned about US fiscal policy and political dysfunction. We've seen volatility in bond markets around the world, not just in the US-European bond. Yields have been fluctuating. Japanese bond yields, which were negative for years, are now positive and rising. Emerging market bonds are experiencing stress as capital flows become more unpredictable. It's not chaos, it's not a collapse, but it's not business as usual either. It's a transition, it's a reconfiguration of the global financial system. And transitions are always messy, always uncertain, and always create winners and losers. The question is, which side of that equation will you be on? What we're witnessing is what some economists call the gradual erosion of the dollar's unquestioned dominance. It's not a sudden collapse. It's not a dramatic crisis like the fall of the British pound after World War II. It's more like watching grass grow or paint dry. It's slow, almost imperceptible day to day, but over months and years, the change becomes undeniable. The dollar is still the world's dominant reserve currency. It still accounts for approximately 60% of global foreign exchange reserves. It's still the currency used in the majority of international trade transactions, particularly in commodities like oil, which are priced in dollars. But that percentage has been declining. 10 years ago, it was closer to 70%. 20 years ago, it was even higher. And the trend is clear. The world is slowly, gradually, but steadily moving toward a more multipolar financial system, where the dollar shares space with the euro, the yuan, gold, and perhaps in the future, digital currencies and other assets. This isn't necessarily bad for the United States. A multipolar financial system could actually be more stable than one dominated by a single currency. It could reduce the burden on the US to be the world's lender of last resort. It could allow for more balanced global trade and capital flows, but it also means the US will lose some of the exorbitant privilege it has enjoyed for decades: the ability to borrow cheaply in its own currency, to run large trade deficits without immediate consequences, to use the financial system as a tool of foreign policy without pushback. So, to summarize, China has instructed its banks to reduce exposure to US Treasury bonds. It's part of a decade-long trend of reducing holdings from $1.3 trillion in 2013 to $683 billion today. It's not just China. Other countries and investors are also diversifying away from US assets. The reasons are multiple: diversification, geopolitics, fiscal concerns, and the weaponization of the dollar. What does it mean for you? Be aware, be informed, diversify. Don't panic, but don't be complacent either. The world is changing, and the smart money is paying attention. If you found this analysis useful, please give it a like, subscribe to the channel, and activate the notification bell so you don't miss future videos. And most importantly, leave me a comment. What do you think about this trend? Do you think the dollar will lose its global dominance? I'd love to hear your opinion. Remember, this content is for educational purposes only. It's not financial advice. Always do your own research and consult with qualified professionals before making financial decisions. Thank you for watching. See you in the next video. Take care.